Hi, and we're back with part two of Chris Gillespie's interview. He is the Director of Growth and Advice at Morton Wealth, guiding clients through comprehensive financial planning. In the first episode, we talked about the basics about getting started with your investing journey. And now we're talking about the stage when you're with your financial advisor, you've got some assets, and we're going to take a deeper look into that. So welcome back, Chris.
Thank you so much, Phil.
So in our previous conversation, we were talking about asset classes and the importance of asset classes, because it's really important for people to understand these, because most people's idea of investing is basically going straight into the stock market. But there are many other asset classes that they should consider. Just talk to us about those, please.
Yeah, I mean, most people think about asset classes and they start at really high level, stocks versus bonds. Within stocks, you have large, medium, small. You've got growth companies, you have value companies, international, same thing. And then you have the fixed income market, where inside of that bigger bucket, you've got corporate bonds to municipal bonds to government bonds. But outside of that, there's a whole world to invest in. And you actually live and breathe this every day. You go to the grocery store, you buy, fruits and vegetables, you own real estate or cars. Maybe you loan a friend money and they have to pay you back plus interest. The other asset classes that are out there are things like gold or commodities. So you've got energy, you've got minerals, you've got gold, you have silver. That fits in that commodity bucket. Beyond that, you've got a whole world of private investments, from private loans backed by real estate, private loans backed by companies or equipment or assets. You've got real estate equity. You can, invest in apartment buildings, single family homes, commercial real estate. And so when you think about asset classes, and crypto is potentially an asset class as well. So when you think about investing, just having stocks and bonds, you're only covering maybe 40% of the world to invest in. There's a lot of other things that people can explore and get exposure to, whether that's in the private markets or, an exchange traded fund that tracks the real estate, tracks the broader real estate market. But, you can't just limit it to stocks and bonds. You have to think real estate. You got to think other forms of currency. You have to think about other types of private loans or businesses. There's a whole world to invest in. So it's a lot of fun.
Okay, so at what stage of life or income or assets should people consider engaging a financial advisor? Is there a threshold? And I know you're going to say it's different for everyone.
Well, look, there's a cost to not hiring a financial advisor, right? And it's the opportunity cost or the life lessons that you learn from the mistakes that you make. Sometimes people are fine with those life lessons or that cost. But typically, depending on the life stage that you're in, let's say you're going through a transition, you're going from, working to getting married to having kids, or, changing jobs and growing in your career. And now you have different forms of executive compensation or types of benefits through your company. You may just want to pay a financial advisor for their time to get the advice that you need for that decision or that structure. And so that's very affordable. You don't need a certain dollar amount or asset. It's just, how important is the decision that you have to make, and how important is it that you get the right choice on the loan or purchasing this house? But typically, to access some of the private investments that we like to invest in, you need to be an accredited investor. So at least make a few $100,000 a year, have a net worth of north of $1 million. Outside of that, I think it's really important for people to kind of put their head down, get good advice and strategy, and save. And once you reach $100,000 or $200,000, and you might be looking to make a decision around that money, do I use some of it for a house or a condo? That's typically where you would engage a financial advisor. It's around executive benefits, estate planning. Do I have the right insurance for my liabilities? And there's a few different ways to get this. You can get a fee-only planner that charges by the hour. You can get somebody that charges a commission that sells you a product. Typically, that advice is geared towards why that product would benefit you. Or you could have an investment advisor like ourselves that can help with the investment management and the advice that you might have throughout your life. And typically, we're a fee-only planner that the only fee that we receive is by the fee that we charge our clients. No other, commissions or sales products there. I think that depends, but it really has to do with like, what's the financial impact if you get this wrong? I think about buying or leasing a car, not a huge financial impact. Buying a new home and using the funds to purchase that home. I hear about people all the time taking money from their retirement accounts to go buy that personal home, and they just get hit with taxes and penalties. And in some respects, you have to look at that and say, was that the right decision to make? Maybe, maybe not. But how did that decision affect the next 30 years of your life? Yeah.
You mentioned the different kinds of advisors. What are they specifically? There's fiduciaries, I believe, and then others as well. Yeah, just run us through
Yes.
the different style of financial advisors around.
So there's advisors that follow a fiduciary rule, which they have to put their client's best interest. So they're not swayed by a commission or a certain product. That's the world that we live in as a registered investment advisor. And not to pick on anybody else, but if you're outside of that world and maybe you're tied to a broker dealer or a big bank, I'm going to name a bunch of them, so I'm not picking on anyone, like Wells Fargo, Goldman Sachs, Morgan Stanley, Merrill Lynch, Bank of America, those types of banks, those are brokerage houses, and you work under something called a best interest contract. And so you just have to justify that the advice and the recommendation that you're getting is suitable for somebody. Suitable and what's right can be a very gray area to walk in. And so you always want to ask your advisor, which side of the table do you sit in? Are you a fiduciary? Do you have to do what's right for me? Or do you just have to show me things that are suitable for me for this time that I'm at in my life? That's a great question to ask.
Okay, and what are some questions you would consider a client should ask a financial advisor before engaging them? What's going to reveal the most about the financial advisor?
How do you get paid? Number one, are you a fiduciary, or do you recommend things that are suitable? If you work in a team environment, or you work at a large organization, ask questions about the team, how they're involved, whether or not they're compensated in a similar way. You might go to a big institution and they might have 18,000 people working for them, but your advisor's working on their own. They're not going to bring somebody else in. I think that's a good question. How do you choose the investments that you think is right for me? If you're really large, why don't you look at, are you able to look at really small niche opportunities and scale them across your clients? Or are you just limited to, really large investment products because you are a large institution? What's the client experience look like for me? How do you help me with, buying a home, working on my estate plan, making sure I have the right insurance? How do you work with my CPA to help minimize, reduce taxes? Those are all great questions, in my opinion. We have an internal Zoom channel where if a client has a problem or something they're trying to solve, we ask our team and our team responds. So we can find contractors to help remodel bathrooms, travel planners to help plan your next vacation. If somebody's looking to do solar, we've got our entire 1,200 client base to get feedback of the things that they learned by putting in solar. So we try to use our entire organization to help clients, and I think that's a great question for people to ask as well.
I heard a term, another guest the other day used the term financial intimidation. And I think that's really something to watch out for, isn't it? When you're talking to a financial or a prospective financial advisor, that you don't feel intimidated by them. They're not using so much jargon, that you actually feel comfortable in how they're explaining things to you.
I think that's really important. Our world has failed people for the financial literacy that's needed. And so I go back to the last episode when I talked about most relationships are built with hope that they can trust. And oftentimes it's that disconnect with being relatable and talking about things that you can understand that creates that financial intimidation, unfortunately. No one wants to feel like they're not smart. And so if you speak to them in a certain way or use too much jargon, they might have a question, but they don't feel like it's a safe space in order to ask that question because they don't want to feel not knowledgeable. And so that's a big challenge that our industry faces. And hopefully with the education and the stuff that we do with our clients, we can break down that barrier and empower people and educate future generations. But unfortunately, that's going to be an issue for quite some time until we start teaching people early enough and often enough. I did an episode on my podcast recently where 67% of people want to have more financial conversations with their kids, but 82% of them don't feel equipped to even talk about money with their kids. And they're just right there. The fact that parents don't feel like they've got the knowledge to talk to their kids about money or debt, that's a huge problem that needs to be fixed.
It's amazing, isn't it, that and there are many parents who say, I've invested in property my whole life. I'm never going to go near any other investment market. And then there's the other ones who say, just invest in, a couple of the large big cap Dow stocks and nothing else. Yeah. And these biases can then play through to the kids as they start their investing.
I have a 5-year-old and a 2.5-year-old, and I read somewhere that over half of your relationship as money is formed by the time that you're 8 years old. And I thought about that. I was like, wow, all the decisions that we make, these kids are absorbing it. And of course, it came true a few weeks ago. My 5-year-old wanted something and she looked at me and said, well, just have Amazon drop it off. And I'm like, I'm failing as a parent. I need to fix this right now because Amazon doesn't just drop it off. I have to work for that money. I have to sacrifice time with them for it. And then we have to make decisions on what's the best use of this dollar. Is it buying that thing? Is it saving over here? Is it investing? And so I've got a lot of work to do, but I think about that often as it relates to being a dad and financial literacy.
Yeah, I was just reading a piece that Bill Ackman wrote the other day and about how tough his parents were on him. He had quite wealthy parents, but they made him work and they made him save. They didn't help him out with any of his businesses. And we know he's worth squillions now. Yeah. But it's those lessons that you impart to your kids can be so important.
Well, part of it is knowledge, and then the other part of it is determination and drive. I think most parents want their kids to be determined and have that drive to succeed. I think about the Japanese and that phrase that they have, ikigai, right? The pursuit of excellence over the course of your life. I don't think anybody's going to look at that and say, oh, that's a bad principle to have. And so as much as possible, I would like our world and our kids to look at the world through that lens. How can I continue to grow and strive for excellence over the course of my life? And then if they're able to do that, they can make the right decision. Is property right for them? Is it owning a couple stocks or an index fund? They'll be knowledgeable and driven enough to where maybe they're not having to rely on somebody else or be a trust fund kid, which, unfortunately happens. And not all trust fund people are bad people. A lot of them donate a lot of time, money, resources, to help make the world a better place as well. So I'm not trying to paint that with a bad picture, but I think about that ikigai, that pursuit of excellence over the course of your life, that drive, that knowledge. Without that, it's very difficult for you to make the best decision for yourself.
Okay, well, before we sign off, is there anything else you'd like to add so that with your vast knowledge, anything else that you'd like to share with viewers?
Just don't let emotions drive your investment decisions. As much as possible, balance that point between fear and greed and know where you are on that spectrum when you're making that decision. And not all debt is bad. But I've really, really enjoyed this time, Phil.
Chris Gillespie, thank you very much for joining me.
Thanks very much. Goodbye, Phil.